The traditional markers of growth are being reshaped by a stark K-shaped divide. Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Michael Normyle, U.S. economist at Nasdaq, Chris Dearborn, managing director on the Nasdaq Market Intelligence Desk, Justin Grooms, president of Bolt, and Kevin Mahn, president and chief investment officer of Hennion and Walsh. It's great to have all of you with us, as always. And Kevin, looking at it from a macro perspective, we're growing, but slowing a bit.
And that's kind of been my mantra for the past few years. But I think there's a lot to like with the U.S. economy right now. If you look at a very macro level, right? The current Atlanta GDP now forecast for Q4 shows a GDP growth rate of 3.7%. We saw most recently we created 130,000 new jobs versus 55,000 expected. The 3-month average now, I believe, is around 100,000 jobs created, which is healthy, not great, not bad, Goldilocks, if you will, not too hot, not too cold. We also see wages rising above the rate of inflation. Core CPI came down to about 2.5%. Of course, we'll get the Fed's preferred inflation gauge this Friday in terms of core PCE. And earnings are pretty darn good right now. We're on track for the 5th consecutive quarter of double-digit year-over-year earnings growth for the S&P 500. All those things taken at a very high level sounds pretty good for economic growth. But looking underlying the scenes, looking at this K-shaped economy, where is the growth coming from? How much can we rely upon the consumer spending to fuel additional economic growth? Or do we need to lean into CapEx spending more, infrastructure spending more? Because I just think back to last year when during the first half of 2025, Jill, CapEx spending on AI infrastructure equaled the contribution to GDP of consumer spending. Yeah. Consumers used to account for 70% of the economic growth in our country. If they do pull back and companies continue to spend on AI infrastructure, perhaps that provides an offset this year and over the balance of this decade. Yeah,
but Michael, what happens if corporations do pull back on CapEx? It seems like it would be an outsized type of move.
Yeah, well, I guess looking at the forecast, the expectation is they're not going to. They're going to increase that CapEx. If you're looking at the hyperscalers, it's going from about $450 billion in CapEx last year to $660 billion this year, so a pretty significant increase. And there is research that was done on the pass-through of that CapEx to GDP. It's about 70% of those dollars spent on data centers ends up in GDP. So it's going to be a continued boost to the economy this year, assuming all that CapEx goes through. I think the healthier situation we could be in is not like last year where it's 50-50 tech investment and consumer spending. If tech is a piece of the economy driving it, but not of half of it. You know, we need to get a little bit more balance where AI CapEx isn't half of economic growth for the economy if we want this to be a sustainable series of growth that we see.
Yeah, but Justin, if you look under the lid here, the customer is evolving in terms of how they're spending, what they're spending on, and really their approach to debt in general.
Yeah, absolutely. We're seeing a lot more consumers going out and using debt to finance even smaller purchases, to maybe buy something today that they're not going to have money for the next 2 to 4 weeks. So that's pulling in even on small transactions that historically we would see on lower cost payment methods, higher costs. So there's more expense though being built into the financial system on these consumer purchases based on the more expensive methods that consumers are using to buy things.
Yeah. Chris, from a Nasdaq issuer perspective, you focus on the retail space, you're talking to Nasdaq listed retailers all day long. How are they perceiving the consumer?
Yeah, the big takeaway is that consumer is still spending across, but not across the board. It's very, as everyone's saying, K-shaped. High-income earners are still spending significantly. You're seeing experiences, eating, food away from home, services essentially. Lower income, though, to everyone's point, is really struggling here, and they're using anything and any method they can to keep that dollar stretched so they can keep food on the table. And you're seeing a lot of companies who can serve the more affluent bucket doing very well, as opposed to a lot of the companies that serve the lower income or even the middle income bracket not doing so well. So you're seeing grocers are having a significantly tough time. Dollar stores, prior to what was supposed to be a fairly quick decision from the Supreme Court back in November, shot up significantly, have kind of held on a little bit, but that's more tariff related than the consumer related. Consumers have been walking away from those stores at the lower end, but you're seeing middle and high income earners trading down into those stores, kind of like a treasure hunt, if you will. So the companies that serve those spenders are doing and continue to do well, while the ones that serve the lower income brackets are struggling.
Yeah, Kevin, it seems as if it's just very bifurcated,
Yes.
right? I mean, if the top 10, 20% doesn't spend, how do you trust that retail data? It sounds different than when Justin is seeing.
Right. But if the
behind the
top
scenes.
10 to 20% continue to spend and they account for 60% of the spending as we spoke about earlier, well, then that can continue to keep this economy going, right? And if you match that with the CapEx spending that we anticipate continuing to take place, at least as it relates to AI infrastructure, if that's overweighted, I agree that's not sustainable, that's not good for the US economy. But if the godfather of AI, Jensen Huang, is correct, and there's going to be between 3 and 4 trillion spent on AI infrastructure by the end of this decade, and we're not even at $1 trillion right now, well, that's a lot more money being spent and thrown into the economy between now and 2030. So there is an affordability crisis. I think everybody at this table would agree with that. Some encouraging signs coming out of that CPI report as we saw shelter costs, sticky shelter costs finally start to nudge down a little bit. Energy costs come down, but food prices aren't coming down, and that impacts everybody. It also impacts their sentiment.
Yeah, it certainly does. But when you think about that data spend, Michael, that could be great for jobs when you're thinking longer term. These are, these operational type of jobs to build these data centers. They're well paid, and that goes back into the economy if you're thinking longer term.
I think the trouble with data centers is it's a lot of temporary employment because you have construction jobs when it's being built. Once they're built, it's only a few hundred people you need to operate them. So it's not a huge driver of employment in the long run. It's a massive amount of land space being used and you're relatively few jobs related to it.
Yeah, I think a lot of it also has to do with reskilling and upskilling, because at the end of the day, it's not just people who are in the technical space that are operating these data centers. You still need operational people. So I think it's going to be a bigger reskilling of the workforce, not just everyone adapting, on how to use AI.
Yeah, that's the two-decade long problem that we're going to have, right? Where people need to figure out what jobs are being replaced by AI, what jobs are being augmented by AI, what jobs are being created by AI, and reskilling to fit those buckets and get people in a productive space for themselves.
Yeah, well, Justin, it's a good conversation to have thinking longer term, because BNPL, it's a bit concerning. What does that do for longer term credit health? I mean, I just learned today that BNPL can be used for your betting apps.
Yeah.
It seems a little bit counterintuitive, when you're thinking about your longer term consumer and credit health.
Yeah, absolutely. What we're seeing is that consumers are using, especially at that bottom part of the consumer, the people that aren't super affluent, are using all different types of debt, including BNPL, to do transactions that we never saw them doing before. We have 80 million American consumers in our network, and we see the digital transactions that they make online every day, every minute. It's shocking to us to see the amount of people that are using buy now, pay later solutions, which don't essentially kind of build your credit over time and don't stack in a way that you can really see how much debt you have, being used to buy groceries, being used, as we discussed, for betting applications, and being used to put gas in your tank. I think what the challenge is, and what really impacts some of these merchants, is that BNPL is very expensive for the merchant. The merchant can be paying 5, 6, 7% in fees for those transactions when it comes through. Compare that to when they have an affluent customer coming into another type of merchant. They might be using a payment type that maybe they're using their debit card and it's only costing that merchant maybe 2%. That has a massive hit on margins that's affecting depending on where those merchants are serving, to your point earlier.
Yeah, that's definitely the whole point. On you talking about which companies are serving the affluent to which are more concentrated into the lower income areas. And a lot of those companies that continue to help and work with the affluent, we didn't even mention travel on top of that as well, right? Are doing very well, and the cost of that business for them is really much less, which goes directly to the bottom line. You look at anything from fast food to a lot of the other stores that serve in those areas, that don't have an AI-centric policy yet, that don't really have stock products that they can sell. Large ticket items aren't moving either. So when you look at the people who are buying who aren't, you're seeing the lower income just really do without, and middle is also getting hurt here too, trading down. So when you look at the stocks or the companies that service those customers, you can clearly pick who the winners and the losers are.
Which is so interesting because you don't hear them actively advertising or pitching buy now, pay later type of services. It just kind of randomly pops up on your delivery app or.
I'm sure if you're a retailer,
FOMO too.
Right. I'm sure if you're a retailer on some level or anything dealing with the consumer, if you had an option not to let your product be used by that, you probably would. Right. Especially if you're talking 2 to 3 extra margin points on the bottom line. Right. That's a tremendous, especially if you're a small mom and pop shop that's, as opposed to larger companies that can actually scale that across their entire business line.
Yeah. Kevin, do you think that exasperates the K-shaped economy?
I do, and maybe I'm a traditionalist, I'm old school, but to me, buy now, pay later is credit cards, right? This is just a different form of buying something now and paying for it later. But I think it's impacting the lower shape of the K more because they're struggling more within this economy. Again, at the macro level, the US economy seems good. It's growing. It's not too hot, it's not too cold. But underneath the surface, there's a lot of cracks that have developed, and it's really impacting the lower end of that K. And that's going to be a significant point of the upcoming midterm elections for sure. And I think it will be a significant part of everything that we're going to be speaking about over the course of the next 3 to 5 months in terms of how do we address this growing disparity between the haves and the have-nots in the U.S. economy.
Yeah, well, it's interesting too. I believe FICO had announced last summer that BNPL is going to start to be reported to the credit agency. That's short term. Short term doesn't usually mean good, right? You want to see longer term history on credit reports. And I just don't feel like there's enough conversation or education around that.
There needs to be, because household debt is at an all-time record high now in the United States, and that's a growing problem. And if the consumer shifts now to servicing all that outstanding debt as opposed to spending, the economy can only slow. So it's an issue.
And speaking of hitting the consumer, Justin, Chris had brought up AI policy and so forth. Identity and security is also an issue, and those costs, of course, do get passed down to the consumer at some point.
Absolutely, and I think that one of the real hidden costs that's in the market right now is that AI, while there are a lot of good applications for it, it's also being used by bad actors, and a small portion of the economy that is bad actors in these types of transaction are using AI to try to circumvent existing fraud prevention systems that are in place. So merchants have essentially spent decades working with partners like us and other folks in the industry to protect themselves from fraud, and now they're getting a much more sophisticated attack. And those costs do really get built in. I think that we looked at a window right now, if you look at a span from the last 3 years to the next 3 years, that 6-year window, we expect almost $500 billion worth of fraud in digital transactions online globally. That's a real expense, but the reason people don't feel it is because it shows up in little incremental costs on every little transaction. The coffee that you buy at Starbucks to the TV that you buy at Best Buy, it's all built in right there. Again, hitting margins, I think, with these merchants.
Yeah, but Chris, as it's built in, I'm sure the narrative is around inflation, or not specific to identity and fraud costs, but just
more incremental spend on the products that you need.
Yeah.
And that's what it comes down to. I mean, Mike can talk a little bit more about that on the inflation part, but when you look at the cost of all products across the board, realistically, we talk about year over year, but if you go back 5 years to COVID, inflation's up, in the high 20s to 30%, depending on the product that you're purchasing. And then you throw tariffs on top of it recently, that's still going to be a major dynamic play out in here in 26. Depending on which way the Supreme Court rules and how it rules, and because it's taken so long. So anything that adds to the bottom line to take cash out of the consumer's wallet and put it into the merchant for the product is going to hurt, especially if you're at the bottom part of the K, right? It's that barbell thought, right? The top of the barbell is still spending, doing well. The bottom, every time you put it down, is getting heavier and heavier, and they just don't have the money to spend on it. So using any type of dynamic that they have right now to keep the goods flowing is one thing. I mean, you talk about SNAP, you can talk about BNPL for other times. There's a lot of things putting pressure on that lower end right now, and it's all coming down to what can they buy and what can't they buy, and they're not going to do without food and if they have a car or gas.
Well, Michael, I think part of the challenge is we look at it through a very market economic lens, right? So people are thinking about what it cost prior to COVID versus when you're looking at economic data month over month, year over year, it might show that inflation hasn't increased at that rate, or perhaps it's flat year over year, but that's not how the average consumer is thinking about it.
Right. The average consumer's thinking 5 years ago.
I think about it that way.
5 years ago, this cost me X, and now it costs me Y, right? And so people wonder, like, why is this so much more expensive? On average, right, wage growth has generally kept up with inflation over these last few years, but it feels like, you know, you're running twice as fast to stay in the same place for a lot of people. And for people on the low end, if they don't own a home, if they don't own stocks, the only source for them to increase their spending is wage growth. And there's data from Bank of America that shows for the lower third of households by income, their wage growth has been slowing the last few years. For the upper third, it's been rising. And those people in the upper third, they have their home that's appreciated in value. They have their stock portfolio that's at record highs, right? So they just don't have, people on the lower end, they don't have the same sources of income to support their spending as much.
Yeah, Kevin, I think you said it off camera, that folks are investing younger because they feel as if they can't afford a home.
Yeah. I mean, I have two 20-year-old daughters right now, both out of college, both successful in their own right, but the thought of actually owning a home in this environment, part of that's the cost of financing, mortgage rates where they are right now, and part of it's supply of new and available homes. So what do? In a lot of cases, they rent, right? And that's just money you throw away, you don't have that back. But now you're starting to see that 20-something young adult considering investing their money, having it grow so that they can purchase and be able to afford a home down the road. So perhaps there's a positive repercussion or a silver lining to the housing affordability crisis for the younger generation, because it's encouraging them to invest. And I just hope that that continues even when they ultimately do have their own home.
Yeah.
I hope they're maximizing their 401k contributions right now and building a diversified portfolio.
Yeah. But see, Justin, you and I were talking about this off camera. There's such FOMO and instant gratification. For example, you know, BNPL for your betting app. I can't wrap my head around that.
Yeah.
So perhaps even with the investment accounts that the government is supplying for, you know, the babies over the past year,
Right.
the $1,000, and we don't have financial literacy as part of the curriculum. Perhaps longer term investing, this could be the way that we're able to spread that message.
Absolutely. I think longer term investing, the other thing that we think is very important and something that the industry is really starting to focus on is pulling together debt and spending power in a way that consumers can get their total picture. I think what's so hard right now is that folks have multiple BNPL lines that are opened up. They might have some credit card lines, they might have personal loans, they might have savings. And you know, they have all this spending power that's essentially available to them. And what they're forced to do today is in general make transaction by transaction decisions. So you walk into that immediate, you're in a Bed Bath & Beyond, you're trying to buy something and, you know, boom, you got to do it. What's the right thing to do right at that moment? In reality, what we want to do is we want to be able to present to consumers a single place that they can go, a way that they can see what their spend power is, and they can start to make those intelligent trade-off decisions, and they can start to understand that, you know, if I'm carrying debt on a 30% APR credit card sitting over here and I'm not investing, man, that trade-off is actually significantly more because of all the opportunity costs from not putting my, you know, I don't care if it's a house or a 401k or investing in a company. Like, I'd like to see people putting more money into productive pursuits instead of servicing
Huge
debt.
opportunity cost.
Well, we'll have to bring cash back. I remember saving babysitting money, putting it in a drawer, and that's how you were able to physically see it grow. And if you spent it, Chris, you
I
had
didn't
no
do
money.
much babysitting. I did paper routes, though.
Either way. All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.